He kept saying, next paycheck. Just needed to catch up on bills, grab that new iPhone, pay the rent, like most baby daddies do. But then groceries doubled, gas spiked, and rent up $400 in 2 years. The market didn't wait. Inflation didn't care. That $50 he would have invested back in 2020, it would have quadrupled by now. Meanwhile, another man, same struggle, same baby mama drama, chose differently. He invested anyway, just $50 a month. No hype, no stress. Now, his money's working while he sleeps. Meanwhile, the other guy, still broke, scrolling his life away, passing up opportunity after opportunity. In part 1, we showed you how to start investing. Now in part 2, we're getting strategic. How do you pick the right stocks? How do you build wealth that actually lasts? Let's break it down. In part 1, we broke down how to start investing into stocks. Now it is time for part 2, where we get strategic. How do you pick the right stocks? How do you build real wealth, like the kind that lasts? Recap. If you missed part 1, we covered the basics: what a stock is, how to open an account, and how to start investing safely. Now, we're leveling up. We're going to keep it simple, but smart. Because this ain't about hype, it's about ownership. Let's get it. Step 1. Understand what a stock really is. A stock is not just a button on your phone. It is a relationship. When you buy a stock, you're becoming part owner of a company. That means if they grow, you grow too. If they fall, you feel it too. So choose wisely. Step 2. Pick a strategy. Before you throw your money in, ask yourself, what is my approach? Here's the 2 main ones. Number 1, technical analysis. Watching charts, chasing patterns, trying to time the market. Sounds cool, but it's risky and not recommended for beginners. Number 2, fundamental analysis. This is the smart route. You study the company itself, its health, leadership, brand, and long-term potential. That's how the rich play the game. Step 3, do basic research. This is where you stop guessing and start thinking like a boss. Look at the company's balance sheet, assets versus liabilities. Use this formula: current assets divided by current liabilities. A number above 1 means it's financially healthy. Then check the income statement. How much do they make? How much do they keep? Use this formula: opening income divided by total revenue times 100. A profit margin above 10 to 20%? That's strong. Finally, check the cash flow statement. Is the company making real money from operations or just borrowing to stay alive? You want cash coming in, not piling up debt. Now, all that sounds good, but where do I go to do this type of research? Good question, and I got you. You do this research on legit platforms that give you full access to company financials for free. Here's where to start like a boss. Yahoo Finance. Type in any company ticker, like APPL for Apple. Scroll to Financials to view the income statement, balance sheet, and cash flow tabs. Morningstar. Great for detailed financial analysis, ratios, and trends over the past 10 to 15 years. It's clean and easy to read. EDGAR, SEC.gov. This is where all public companies file their official reports. Look for the 10K, which is annual, or 10Q, which is quarterly, to get raw, unfiltered info. Public.com, Seeking Alpha, or simply Wall Street. These apps break things down in visuals and easy-to-understand summaries, great for beginners. So don't just invest off hype or TikTok clips. Pull the receipts, because bosses verify before they buy. Step 4, qualitative analysis. Now step back and ask, is their brand strong? Do they have great leadership? What's their edge over competition? Think of companies like Apple. It's not just about numbers. It's about loyalty, reputation, and how hard it is to copy them. Those are hidden assets. Step 5, choose the type of stock. you'll hear two main types. Value stocks. These are steady, affordable, and often pay dividends. Think Coca-Cola, JP Morgan. They're the slow and steady kings. Growth stocks. Big upside, but risky. They usually don't pay dividends. Think Amazon, Tesla. High risk, high reward. Choose your flavor. Build a diversified portfolio. Don't fall in love with one stock, just like Future said, she for everybody. And don't go all in on one industry either. Diversify like a boss. Here's the formula to stay safe. Invest across at least 5 sectors. Mix in stocks from different countries. Own 25 plus different stocks. Keep no more than 5% in any one stock and no more than 20% in any single sector. That's how you stay strapped to protect yourself and sleep at night. Use a simple app to buy stocks. You don't need a laptop or a suit. All you need is a phone and the right app. Try Trading 212, which is Europe, Yahoo Finance, Robinhood, or Fidelity in the US. Open an account, search for a stock like Coca-Cola, review the info, and buy a fractional share if your money's tight. Simple, clean, efficient. Use promo codes when you sign up. Some apps give you free shares just for joining. So now you know how to research, how to choose, how to build a real portfolio, one that grows with you. This is how we break the cycle. If you found this helpful, hit like, drop a comment, and share it with another young dad trying to get his money up. This is Rich Baby Daddy, Poor Baby Daddy. We build legacies, not excuses. Subscribe, and let's get this money.